Today, we're diving into some of the most dramatic moments in financial history, the great stock market crashes. We're going to look at what caused them, how they unfolded, and most importantly, what timeless lessons they hold for all of us today. So, what is the biggest fear for anyone who invests? That one single thought that can keep you up at night. It's this, isn't it? The fear that everything you've worked to build up could just evaporate. The idea that in a matter of days or even hours, the world could become a completely different place. Well, today, we're going to face that fear head-on by exploring the stories behind these massive market collapses. And of course, we have to start with the big one, the crash of 1929. This really became the blueprint for every crisis that followed. This wasn't just some market correction, it was the event that triggered the Great Depression. To really understand the crash, you first have to understand the party that came before it, the Roaring '20s. What a decade of incredible optimism. World War I was over, new technologies like the automobile were changing everything, and the economy was absolutely booming. It really felt like the good times would never end. All this optimism turned the stock market into a national obsession, and the engine fueling this rise was something called margin trading. The concept was pretty simple. You didn't need all the cash to buy a stock. You could just put down a small payment, maybe 10%, and borrow the rest. It supercharged your potential gains, but, as history showed us, it also supercharged the risk of catastrophic losses. And then, the music stopped. And it all happened so fast. On October 24th, Black Thursday, the first wave of panic selling hit. Over the weekend, bankers tried to calm things down, but it was no use. The next week brought Black Monday and Black Tuesday, with the Dow dropping a combined 25% in just 2 days. The panic was officially on. But those few days, they were just the beginning. The slide to the bottom was long and absolutely brutal. From its peak in 1929 to its low point in 1932, the Dow Jones Industrial Average lost an unbelievable 89.2% of its value. Just think about that. For every dollar invested, almost 90 cents was just gone. And the impact went way beyond just numbers on a screen. The crash plunged the entire world into the Great Depression. A quarter of the workforce lost their jobs, life savings vanished as banks failed, and global trade just ground to a halt, shrinking by 2/3. It was a global economic catastrophe. Okay, let's fast forward to the modern era. Because, as we're about to see, every new wave of technology seems to bring with it a new wave of speculation, and often a new kind of crisis. Let's look at these two crises. In '87, the problem was the new financial tech itself, computer programs that automatically sold stocks when the market fell, creating this devastating feedback loop. In 2000, the tech was the internet, but this bubble wasn't inflated by algorithms. It was pure, unadulterated hype about the new economy. This number right here defines the 1987 crisis. On October 19th, Black Monday, the Dow fell 22.6% in a single day. That is still the worst single-day percentage loss in the index's history. The speed of it was just breathtaking. And how about this quote? This was the mantra of the dot-com era. It perfectly sums up the mindset. It didn't matter if your company was profitable. It didn't even really matter if you had any revenue. The only thing that mattered was grabbing market share, building a brand, and growing fast. Profits, well, they could come later, maybe. And here are just a few of the famous casualties of that growth before profits mentality. Companies like Pets.com with its famous sock puppet mascot, or Webvan, the online grocery delivery service. They burned through hundreds of millions in investor cash before spectacularly crashing and burning, becoming symbols of the era's excess. And now we get to the crisis many of us remember personally. In 2008, it was different. This wasn't just about stocks or one single industry. It was a near-total meltdown of the entire global financial system. So what made 2008 so different? Well, while other crises started locally and then spread, this one was, as one research group put it, global from the get-go. The toxic financial products at its heart were held by banks all over the world, which meant when the first domino fell, everyone was already exposed. So how did it all go down? It was a devastating chain reaction. It started with risky subprime home loans in the US. Then, Wall Street's financial wizards bundled thousands of these risky loans together, slapped a safe rating on them, and sold them to pension funds and banks all over the world. When homeowners couldn't pay, these supposedly safe investments blew up, taking down huge banks like Lehman Brothers and leading to a credit freeze that paralyzed the entire global economy. And to see the scale of the problem, you just have to look at the explosion in these subprime loans. In just 3 years, their share of the U.S. housing market more than doubled, going from under 9% to over 20%. The financial system was just flooded with toxic debt. These global events are like earthquakes. They send shockwaves everywhere. To see how that works, let's look at a specific case, the impact on Turkey and its stock exchange, Borsa Istanbul. A research foundation called TPOV analyzed the 2008 crisis, and they identified 4 specific channels through which that global shockwave hit the Turkish economy. Here they are. First, the credit channel. Suddenly it got a lot harder for Turkish banks and companies to borrow money from abroad. Second, the portfolio channel. Foreign investors got scared and sold off their Turkish stocks and bonds. Third, trade. Turkey's export customers in Europe were in recession. And finally, the confidence channel. Everyone from consumers to business leaders got pessimistic and stopped spending. And the combined effect of all these channels was brutal for the Turkish stock market. The main index, the BIST 100, was cut in half, losing about 50% of its value as the global crisis rolled in. Now, this table puts that 2008 crisis into a different context, showing how the Turkish market reacts to different kinds of shocks. Notice the sharp but really quick drops from events like the coup attempt or COVID. You can contrast that with a much longer, deeper bear market triggered by the Pastor Brunson crisis, which actually led to an even bigger percentage drop than 2008 did. So after looking at all these different crises across the decades, it really begs the question, does history actually repeat itself? Well, maybe not exactly, but the themes are remarkably consistent. You find the same ingredients in every single crash: a wave of irrational optimism, huge amounts of debt fueling speculation, complex new financial gadgets that nobody fully understands, mob psychology where everyone rushes for the exit at once, and regulators who are always playing catch-up. And that brings us to the final crucial question. We've seen crises triggered by margin loans, internet stocks, and complex mortgages. So when we look at the world today, at AI, at crypto, at massive corporate debt, you have to wonder, which one is planting the seeds for the next big one? Now that's something to think about. Thanks for joining us for this analysis.